What's going on, ladies and gentlemen? ANZD back at you with another video. And in this video, I want to talk about more about some option trading and some of the strategies that I've been using to do some option trading and how using these strategies can probably help you out. Now, I just want to go across the strategy because I'm not even sure exactly what its name or what it's called, but I kind of got an idea from doing some research before on option trading and different strategies to use in option trading. Now I use this trading strategy in order to make about $375, probably a little bit more, within a couple of hours, and I'm gonna go across how I did it in this video. And I didn't even have to have a lot of money. I basically started with well, for this trade it was less than $200, but for the contract, I only spent about $93 on the contract, and it's because of the strategy that I use. And like I said, I'm going to go across some more strategies in terms of option trading while I'm learning these strategies and while I'm using these strategies. So some of the strategies that I probably end up going over later on in some other videos will be like covered calls and how it works and the importance of it. Also like a married put, also iron condors. Those are kind of risky if you don't know what you're doing. Also bull call spread. I'm going to get more into a bull call spread and when to use it and its risk and rewards. And also probably do something on some bear put spreads. And also what is another one? Well, I already said cover calls. So cover calls and puts and barefoot spreads, and we're going to go across some of those and how it works and when to use it and the best risk and profit that each of them will give out. Now this strategy, I have to do some more research because I got to get exactly the idea of strategy and what it's called. It's almost like the iron condor, but it's not an iron condor strategy because an iron condor strategy usually use about 4 different contracts. You would have a long call and a short call in addition to a long put and a short put, and those basically your expiration date probably be within a week, and another contract will be maybe 4 weeks to a month or 3 months. And you have the shorts will have the same expiration dates and the longs will have the short expiration dates. So you're basically doing a short call and put and a long call and put with the same expiration dates. So it gets kind of difficult when I trying to explain that one, but let me get into a more idea of how I probably basically reduced it. So instead of having 4 different contracts, I only had 2 contracts, 1 call, 1 put, with the same expiration date, but there was different strike prices on these. So for example, how I went about it was on Friday. So Friday, a news came out and Donald Trump basically was saying, the President Donald Trump was basically saying that the tariffs are working and things like that, and the stock market will be looking good. And he said some quote like, go ahead and buy stocks or whatever like that. So once you hear some things like that, like, you know, you probably heard the saying before, buy the rumor, sell the news, or however it's supposed to be, buy the rumor, sell the news. Whatever. I was hearing the rumor, I was hearing the news. So I basically got into it with both a call and a put because I didn't want him to say, okay, well, go ahead and buy stocks, and then when the stock market opened up, everybody's selling off their stocks, because you have people who are able to trade after market hours. That means pre-market and after market hours. They're able to trade like basically overnight. And I'm still trying to figure out like, who are these people that are trading these stuff while the market are closed? Are there people from like across the pond? Are there people from like Japan and China? Or is it just accredited investors and they have access to trading after hours? Like, who exactly gets to trade after market hours? So I'm gonna get into a video because I'm gonna do some research on that, because I'm trying to learn this stuff. So whatever I'm learning, I'm going to try to come on here, be as transparent as possible, and share what I'm learning. So like I said, so basically I went off of the news that he was saying, hey, buy stocks now and the stock market will be looking good. So I said, all right, let me do this. Instead of just going ahead and buy some calls, and I didn't buy calls within the money. If you don't know what I'm talking about when I say like in the money or out the money, I did do a video on buying option or getting involved with option trading with a low budget, because if you get involved with option trading, and I'm using the SPY for this trade, that's the S&P 500, the SPY, I'm using it. That's the one that I majority use. And I'll let you know if I switch up to like SoFi or Palantir or the Tesla or Apple. Those are the only probably other ones that I would use for option trading. But all the time, majority of the time, it will be most likely will be the SPY. So looking at the SPY now, if I did a call option or a put option within the money, it was costing. So basically, like I said, I look outside of the money and I look for an expiration date that's not too far away where it's gonna cost a lot, but close enough where I can have enough time to like wiggle around or adjust it or pivot or reduce my my average cost. I can reduce my average cost. So I give myself more like about a week to a week and a half so I can really have an idea of how the market is going to take onto these contracts. So what I did, like I said, so I did on Friday about 2:50, 3 o'clock-ish, when the news was starting to come out about President Donald Trump was saying, hey, now is a good time to start buying stocks, to get involved with the market, to go ahead and buy stocks because stocks are going to be going up. So just off of that news alone, I knew something was going to happen with the market. They was going to either bite it and it was going to end up, a lot of stocks was going to end up going up, or people was going to end up having it flash up over the weekend and drop down. So like I said, I basically did 2 contracts. One was a call contract and the other one was a put contract. And how I went about doing this now, the expiration date was about a week and a half. Yeah, about a week and a half, because the expiration date was for the 21st of May. So I did a call, was a 585 strike price for an expiration date of 521. And I was able to, like I said, what I do in that video, like I said, I will scroll down and I try to find that contract that I'm gearing towards, but at a cheaper price. So that means for me, I would have to have the strike price will have to be higher, or the expiration date will be closer to the time. So like, say if you buy a contract today and you want to close expiration date, then your close expiration date will probably be either Wednesday or Thursday. My close expiration date was about a week and a half away, so I can really see how the market is going to react to these contracts. Then after that, I bought the call contract, but after about 10-15 minutes, I didn't see it really moving anyway. It was what they call capitulating. So basically, it's just going like this. It's not really making any big moves or anything like that. So it's capitulating. So I said, okay, everybody's not really grabbing onto this news like that. So in order to hedge against my call contract I end up buying a put contract for $530. And remind you, at the time of buying the contract, the strike price was in the money. So the strike price in the money at that time was about 568, 571. Probably like not even less. Yeah, about 568, 571-ish, right? So like I said, so then I got the put. The put even started to capitulate. It wasn't even making any big moves, because basically I had the call and the put. So whichever one was gonna make a bigger move, then I probably was gonna do a stop limit loss on whichever one is taking a loss. So say for example, if the put would have went down by like $15-20, I probably would have did a stop loss and just rolled everything, or just buy another contract with the 585 call contract expiring on the 21st. So going back to this now, I bought 2 contracts. One was for 585 call contract expiring 521 at the $93 price, and another one to hedge against that call, I bought a $530 put expiration date with the same date of 521, and that contract cost me $87. And like I said, they was both capitulating, so I didn't do anything with them over before closing hours, which is about for the SPY, it's about 4:15 on weekdays. So about Friday, about 4:05, I see they wasn't really doing anything. One had lost about $5 and another had lost about $10 just because of the Greeks and the expiration date, whatever have you. However that works out, right? So I was like, okay, I might as well keep it open. Then over the weekend now, the news is coming out like, yeah, the stock market looked like it's going to be bubbling, because the after hour market, it was moving. Prices was going up and everything. So I was like, okay, let me try to set me buy me another contract, another call contract, and hopefully it will kick in before Monday morning. Unfortunately, it didn't kick in. But what happened now is that the price of the SPY, it gapped up to about, I think 5. So early this morning, market opened about 9:30. By about 9:45, 9:50, the SPY had gapped up to about 580, 581. And to remind you, it was down by it was down in the 568 range. So that it skyrocketed up probably about $10, $11 within about 30 minutes or so. So I was able to cash out on that contract. And remind you, I purchased it at $93 for that contract, and I end up cashing it out. I think it's probably even more than that. I think it was like maybe probably like 3 something, 4 something. I can't exactly give you the amount right now because I don't remember. I took a picture of it, but I basically took a picture of it, but it's basically about 375. That's when I put my stop loss on. So I put my stop loss on because I see it was kind of still going up. So I put my stop loss off for the 375-ish area, and then it actually went up into the 4s, but it gapped back down and locked me out. So it canceled me out, but I was still able to profit off of that because, like I said, I was able to make like $375. Not to mention now the other contract, now the put contract, however, I lost, but I kind of offset it because I have gained so much off of the call contract that I was able to basically it more than break even. So it was able to cover for the cost for the call, for the put contract, and I also had a stop loss on the put contract. So it knocked me out at about $50, and I went back in. Now, with the profit that I had, it knocked me out at about $50, but that put contract went down to about $25. So with the $50 now that it knocked me out of, I basically lost probably what, $37 off of that contract. Not technically lost, but like what they call it, unrealized loss, basically. What the fuck? Wow. Oh, sorry, y'all. These people was racing down the 2-lane. They both was in it's a 2-lane, one go one way. They both was in it, each lane, speeding and racing. So that's why, my bad. Sorry for the language. You two don't get me for that. So so back, right? So then it locked me out at the $50, but that put contract ended up dropping even more. So I took the $50 and I bought 2 more contracts. Each contract was about, one of them I bought at $24 and the other one I bought at $23. So hopefully those put contracts within about a week or so will come back. Maybe the SPY would end up dropping back down, maybe to like maybe the 560, 558 range, and I probably would be able to profit off of that. If it doesn't, then I end up losing like $40 or $50 off of that put contract. But remind you now, with that said, I came back in it with another profit. Usually like around power hour, I see how the market is going, and I was able to buy another contract. Like I said, I go with the expiration date farther out, and I tried to get a price within my budget. So I found a call contract that was about $95. I had bought a call contract about $95 at about $335, $330-ish. That contract ended up losing about $10. So I had dollar cost average because of how the market was looking. I dollar cost average bought me another contract, and by about 3:55, 4 o'clock, both contract each had about $20. So I ended up getting like a quick $40 within about a 30-minute trade. So that's just different strategies and things like that. Learn those different strategies, learn the charts, learn the support and resistance. And for me, my main thing, I don't go out try to find, okay, which is going to be the hot stock, the option trade. I focus on a few option trades, few shares, few contracts, and just like 2 or 3 different not shares, 2 or 3 different stocks. Like I said, I got the SPY, the Tesla, Palantir, SoFi, and Apple. So once again, it's ANZD. I hope you got a little value out of this. I hope I wasn't babbling and rambling too much. I hope you got some gist of it, of how I was able to use this strategy. I basically bought a call and then I hedged myself with a put, and it was able to profit off it. So once again, it's NZD. Hope you got some value out of this. Make sure you hit that like button, subscribe to this channel, because I'm be sharing more of my option trading journey, and I hope you get some gems and nuggets off it. What is going on? They just racing around the block. I know it's a nice day, but jeez, they just flying around the block racing. All right, once again, it's NZD. Hope you got some value out of this. Hit that like, that subscribe button. I'll see you next time. Be safe. Peace.